Welcome back to the Deep Dive. Today, we're jumping into Gufic Biosciences Limited and their Q4 and full year FY25 earnings call.
Yeah, we're going to unpack the key takeaways, try and figure out what it all means for, understanding how the company's doing and where it might be headed.
Exactly. We've sifted through the call, pulled out what really matters.
It's quite a picture, actually. A company making some big strategic moves, investing heavily while, still running the day-to-day. We'll get straight to the important bits.
Okay, let's kick off with the numbers. The headline figures for Q4 fiscal 25, comparing it back to Q4 24. Revenue first.
Right. So the top line, revenue, it actually saw a small increase. Came in at 200.5 crore rupees, up from 195 crore last year. So yeah, a little bit of growth there.
Okay, revenue edged up. But what about the profit side?
Well, this is really the main story from the numbers, I think. Profitability took quite a noticeable hit this quarter. EBITDA, that's your earnings before interest, taxes, depreciation, amortization.
Sort of your core operating profit measure, yeah.
Exactly. That dropped from 35.1 crore down to 27 crore. Profit before tax, PBT, fell even more sharply. That went from 27.1 crore right down to 10.8 crore.
Wow, okay. And the bottom line, profit after tax?
Yeah, PBT, that also declined significantly from 20 crore rupees down to just 8 crore rupees in the quarter.
That's a serious squeeze. And I guess that shows up pretty dramatically in the margins then.
Oh, absolutely. The EBITDA margin, which was a pretty healthy 18% last year, dropped to 13.16%. And the KT margin, the final net profit margin, fell off a cliff, really, from 10.28% down to 3.94%. Yeah, significant pressure.
Okay, so that's Q4. What about the full year picture, FY25 versus FY24? Similar trend.
Pretty similar, yeah, though maybe not quite as stark as the Q4 drop. Full year revenue was also slightly up, 819.8 crore versus 806.7 crore.
Right.
But again, profitability was down for the full year too. EBITDA came in at 138.6 crore compared to 148 crore the year before. And full year PAT was 69.9 crore versus 86.22 crore in FY24. So margins were lower for the full year as well.
So summing it up. Revenue kind of flat to slightly up, but profits and margins definitely squeezed, especially hard in Q4. Did management give a clear reason for this?
They did, yeah. They were very upfront about it. It's primarily down to the capitalization of their big new indoor facility.
Indoor.
Right. So, think of it like finishing building a house. Once it's officially done and on the books as an asset that happened in Q3, you immediately start paying all the running costs in the next quarter, Q4.
Like the mortgage, the heating bills, the property tax.
Exactly. For QIT, that meant absorbing higher fixed costs like salaries for the indoor staff, utilities, and crucially, depreciation on the new building and equipment, plus the interest on the loans they took out to build it.
Okay.
The CFO actually put a number on it for Q4, said there was an 8 crore rupee incremental hit just from depreciation and interest tied to indoor in that quarter alone.
Right. So the facility's built, it's on the books, but it's not fully churning out revenue yet. So they're paying the costs before getting the full benefit. That makes perfect sense for the margin pressure. It's an investment cost hitting the P&L now.
Precisely. Near-term pain for hopefully long-term gain. It's the cost of that big investment showing up.
So let's dig into how they plan to actually use that facility and what else is going on. The CEO gave quite a bit of detail on strategy across different divisions.
Yeah, they're definitely focusing their efforts. Take critical care. They've directed their sales teams towards the hospitals with the biggest potential, like ICUs and emergency units.
Makes sense. Go where the need is greatest.
Right. And they're really engaging with the specialists, the consultants, using real-world evidence, especially around things like antimicrobial stewardship and sepsis control, trying to build credibility.
And are specific products doing well there?
It seems like it. They called out Kin, their cefepime-tazobactam combo, as leading its category. And they mentioned strong positions in antifungals too, like caspofungin and micafungin. They see these wins as sort of a foundation for introducing new products later.
Building that trust and presence first. Okay, what about Sparish? That's their direct-to-hospital channel, and the contrast media business they're starting.
Yeah, this one's interesting, especially because there have been shortages in the market for contrast media. QIT is apparently testing their own offerings with some key hospitals now, getting that early feedback, focusing on reliability before they go for a big launch.
So they're being cautious, doing internal trials, studies, getting data for the hospital procurement teams, not just rushing in.
Exactly. Build the confidence first. The plan is for a full launch soon using their own in-house range, which they expect will add new volume. And they specifically mention leveraging the indoor facility for the bigger batches later on.
Got it. How about the fertility division? What's the focus there?
They've actually brought in an expert, a Dr. Zival, to really sharpen the scientific positioning of their products, especially gonadotropins, those key fertility hormones.
So more science-led marketing.
Seems like it. And deepening ties with reproductive medicine groups. They highlighted one product, Guisin Alpha, for tough cases like recurrent implantation failure.
Are they generating their own clinical data too?
Yes, that's a big part of it. They're running multi-center trials for Gufic Alpha and also for Supergraph, which they said is India's highest strength HMG product. The goal is clear: get solid clinical evidence comparing their stuff to competitors. That's key for getting onto formularies, the lists of approved drugs in clinics and hospitals.
Right, data toxin medicine.
Okay.
Let's switch to the botulinum toxin business. This got a lot of airtime later in the Q&A, but management covered their efforts in dermatology or astrodome and neurocare first.
Yeah, this is clearly a big focus area, likely high margin. Dr. Vijay Kumar is heading up the derma side. Their product, a Cadmox, which is India's first domestic botulinum toxin type A, they said it's already treated 50,000 patients. They're framing that as building trust.
And they're putting resources behind it.
Definitely. Lots of training. They mentioned 112 training sessions just in Q4, upskilled over 600 doctors. Plus, they're doing local clinical studies to get data specifically on Indian patients.
So in derma, it's about training doctors and getting local evidence to build confidence, especially in what sounds like a pretty fragmented aesthetics market. What about the neurocare side of toxin?
There, the focus is purely therapeutic, expanding its use into areas like urology, chronic migraines, spasticity, pain, neurosurgery. They've actually expanded their sales team into new regions across India to push this.
And is it working?
Seems to be gaining traction. They claimed a 17% market share now in neurocare toxin use, which they said is up 10 percentage points just in the last year. Training is vital here, too, making sure specialists know the protocols for these different therapeutic uses, patient selection, all of that.
Okay, clearly a growth engine for them. Did they talk about any structural changes internally, something about merging divisions into Zenova?
That's right. They combined two divisions, Spark and Stellar. The logic they gave was basically efficiency. Eliminate overlapping teams, make sales territories more rational, and get the new combined team focused squarely on the highest margin brands they have.
So fewer, more productive sales calls, optimized territories, maybe lower overheads by consolidating offices and shuffling staff.
Streamlining.
Pretty much. Focus on the big contributors like Stretch, Diroic, Monobase, QF3 they mentioned.
Okay. What about their in-healthcare division? Here, the strategy seems to be targeting common conditions that maybe aren't perfectly served currently. Things like cervical spondylitis, osteoarthritis, gout. They're also moving into wound healing with something called WH5 gel, which they flagged as patented, and a first mover in Ayurvedic wound care, and launching a new GI molecule.
How are they driving prescriptions there?
They mentioned using targeted screening camps, ran about 475 of them, identified over 3,000 at-risk patients, and are converting those into prescriptions for brands like Wubispan and Beryl DX. They also hinted at a pilot launch for a next-gen anti-arthritic oil coming next quarter.
Lots going on domestically. What about the international push?
Yeah, big focus there, too. They appointed a Dr. Rajar to lead the charge into both regulated markets, think U.S., Europe eventually, and emerging markets.
Any key deals?
Yes, a significant one. A distribution agreement covering 17 LTA countries. We think LTA means less than advanced, basically emerging markets where they can get products registered potentially faster. They've already got 7 product approvals across Myanmar, Sri Lanka, Cambodia.
And getting the factories approved is key for exports, right?
Absolutely critical. They highlighted getting a GMP extension from the Thai FDA for their Unit 2 facility. GMP is good manufacturing practice, basically a quality certification. That Thai approval can help registrations elsewhere. They also won a tender in Sri Lanka for some complex injectable products, and they're setting up offices like in Vietnam, exploring others like the Philippines, laying the groundwork.
Okay, so lots of initiatives aimed at growth. Let's swing back to that new indoor facility. It's central to the plan, but also the source of that recent margin pain.
Right.
What's the latest on getting it up and running?
Well, management explained those validation delays were really about ensuring it meets the super high standards needed for export markets. Took longer, but they feel it de-risks future audits from global regulators. As we said, capitalized in Q3, costs hit hard in Q4.
Did they give more specific guidance on the financial drag going forward?
Yes, they did. They expect the total extra cost from Indore, specifically interest and depreciation, to be around 36 crore rupees for the whole of FY26.
36 crore for the year. So that works out to roughly 9 crore rupees per quarter.
Exactly. About 9 crore a quarter in fixed costs hitting the P&L before the facility starts generating significant offsetting revenue.
So that margin pressure we saw in Q4 management is basically saying, expect that level of pressure around 9 crore a quarter to continue for the next, 2 or 3 quarters?
That's what they indicated, yes. Next 2-3 quarters. That's a really key piece of guidance.
Okay. So how are they ramping it up then? What's happening now?
Full steam ahead on the ramp-up activities. They're booking audits with major customers for their CMO business that's contract manufacturing for other companies, and getting ready for inspections by global regulators like the FDA or EMA.
What else is involved in that? Tech transfers?
Yep. Moving manufacturing processes for specific products, SKUs, stock-keeping units, into the new facility. They said they've started transfers for 33 internal SKUs and 18 from CMO partners. Plus, developing 15 brand new products right there in the indoor R&D center.
So, lots of activity. But when does this facility actually start helping the bottom line, not hurting it? What's the timeline?
Their immediate focus, they said, is nailing those domestic customer audits, running initial batches for stability testing, and getting international dossiers filed to kick off the global audit processes. They can take domestic orders now, but they sounded cautious about pushing too much volume right away while these crucial audits are happening. They need the plant looking perfect.
Right. Prioritize passing the inspections and the financial break-even points.
Okay, so management expects the facility itself to reach EBITDA break-even, covering its operating costs before financing and depreciation sometime in FY26.
But not profit after tax.
Correct. Because of the significant debt they took on, the interest payments plus the depreciation charge mean they expect Indore will still show a loss at the PATE level in FY26. They're targeting PATE at a break-even where revenue covers all costs, including financing, only in FY27.
Okay, peak break-even FY27. That's an important distinction. What about the long-term potential, peak revenue?
They estimate peak revenue from Indore could be around 800 crore rupees a year, maybe in a 700-900 crore range. They think they'll get to 70-75% utilization, supporting that revenue level around FY28 or FY29.
But that depends heavily on getting international approvals.
Absolutely. They stress that. Getting the green light from the US FDA, European agencies, South Africa, etc., that takes time. They mentioned timelines of 18 to 30 months, varying by country. For this coming year, FY26, they expect maybe 150 crore in revenue from Indore, mostly shifting existing domestic production over, plus some new domestic business. Significant international revenue from Indore isn't expected until late FY26, becoming the main driver in FY27 as approvals hopefully come through.
Right, a clear picture. Invest now, pay the cost now, profits come later.
Oh, okay.
Okay, let's look at the Q&A. Investors clearly wanted more detail on some areas. That botulinum toxin business came up again, right? They wanted to know how big it really is.
Yeah, definitely. Management gave some market size estimates for India, about 75,000 vials a year for aesthetics, maybe 60,000 for neurology. QIT's current share, they said, is around 9% in aesthetics and about 16% in neurology.
And its contribution to QIT's total revenue right now?
Still pretty small, actually, around 3-4% of total revenue. But they emphasized it has very high gross margins, like 80-85%.
But they're spending a lot to grow it.
Oh, yeah. Heavy spending on marketing, trials, doctor training. About 40-45% of the toxin division's revenue is going back into building the market.
High potential, high investment. What are the growth targets?
Pretty ambitious for this year. They're aiming for 20-22% market share in aesthetics and 25-26% in neurology. Longer term, they floated a target of 100 crore rupees in revenue from the whole toxin business within 3 years.
Any hurdles mentioned?
They did flag one challenge: lack of insurance coverage for therapeutic uses in neurology. That obviously impacts patient access.
Okay. International business targets were also discussed.
Yep. Management reiterated their goal: lift international business from its current 16-18% of total revenue up to 25% within the next 2 to 3 years.
And the absolute export revenue goal?
They're aiming for export revenues to be 1.5 to 2 times what they are now within the next 3 to 5 years. And the new indoor facility, once approved internationally, is key to hitting that.
That margin pressure. Investors clearly pushed on how long that would last. We know the cause, but what was the CFO's explicit timeline again?
Yeah, this is crucial. The CFO confirmed Q4's drop was mainly indoor costs plus some salary hikes at their older Navsari plant. And she specifically said they expect this pressure to continue for the next 2 to 3 quarters because of that roughly 9 crore per quarter fixed cost burden from indoor until it starts generating more revenue.
Okay, crystal clear guidance on near-term pressure. And just to nail down the indoor timeline from the Q&A, EBITDA positive FY26, but PAT losses expected in FY26, PAT break even only in FY27. That lag at the bottom line is purely the interest and depreciation, right?
Exactly. The factory might start covering its own running costs, EBITDA, but the sheer size of the investment means the financing costs, interest, and the accounting charge, depreciation, will keep dragging down the final net profit, PAT, until FY27 based on their forecast.
Got it. Any other interesting nuggets from the Q&A? Contrast media details?
Yeah, a bit more color there. They confirmed the soft launch is using the Navsari plant for now, smaller batches. They plan to shift to indoor for larger scale production from July 2025. Margins targeted around 50-55%.
And revenue potential.
They see it contributing maybe 5-6% of the critical care segment's revenue in a couple of years. Minimum 15-20 crore rupees just from the initial iodine products, with gadolinium products planned for later to add more potential.
How about updates on the fertility products in trial?
Okay, so Europatrocan alpha, their recombinant FSH, is heading into trials for Indian regulatory approval, DCGI-CDSO. That usually takes about 2 years, they said, so no commercial revenue really expected before the end of FY27.
And the others, Supergraph and Buffin Alpha.
Supergraph trials are running, hope for results by end of FY26. Early signs apparently good. Buffin Alpha trial is also ongoing. They acknowledge they need to kind of build the market for that one, but they're hoping for maybe 8 to 9 crore rupees from it this year, FY26.
Anything on capacity at the older sites or debt?
Management described the Navsari plant as chock-a-block for some lines, like lyophilization, but said liquid filling has headroom. The Belgium facility is apparently fully used for their own internal needs, making nutraceuticals for brands like Salaki. And yes, they confirmed repayments on the 160 crore debt for indoor started in April 2024.
And did they rank the margins across the business segments?
They did give a general ranking. International business has the highest margins, then domestic, and then the CMO, contract manufacturing business, has the lowest margins of the 3.
Okay, we've really unpacked the core messages from that call. Let's shift gears for a second. Now, this is purely a thought exercise, absolutely not financial advice. But if we take only the information and the explicit guidance management gave in this call.
Based strictly on what they told investors on the call.
Yeah.
Right.
So here's the setup management laid out. Q4 margins got hit hard because indoor costs started flowing through. The CFO explicitly said this pressure, about 9 crore a quarter, continues for the next 2 to 3 quarters.
Yeah.
They guided for EBITDA break even at indoor in FY26, but importantly, PAT losses in FY26, with PAT break even only coming in FY27.
So management themselves are signaling that the next few quarters' bottom line will show the financial drag from this big investment.
Exactly. Now, there's clearly a compelling long-term story here. The potential of indoor, the toxin business growth, international expansion, that's the narrative. But the near-term financials are guided to remain under pressure. Indoor's peak contribution is years away, FY28, FY29, and depends on those long lead time global approvals. So while the standard view might be to look through the near-term noise to the long-term potential, an outrageous but plausible idea based only on this call's specific guidance could be a short-term perspective. One that maybe anticipates the market reacting negatively if near-term results in the next 2-3 quarters reflect that guided margin pressure. Or perhaps if expectations haven't fully absorbed the FY27 timeline for PAT break-even from indoor.
So you're saying it's outrageous because it goes against the obvious long-term growth story.
Right.
But plausible because the company itself has clearly signposted this period of near-term financial strain and the delayed profitability timeline for the big new asset. It's about betting on the market's potential reaction to that immediate guided reality.
That's the hypothetical framing, yeah. It hinges entirely on management's own explicit near-term guidance. Again, purely speculative, just exploring implications of the call details, absolutely not financial advice.
Understood. Definitely not advice, just connecting the dots from what was actually said on the call.
Okay, so let's wrap up this deep dive on QIT Biosciences. The main takeaway really is a company deep in a major transition. The recent financials clearly show the upfront cost of investing heavily in future growth, especially that big indoor facility.
Yeah, it's that classic balancing act, isn't it? Managing the immediate costs, the complexities of ramping up a new plant, getting approvals, transferring products, all while trying to build towards that significant long-term growth they see from indoor, plus their other bets like botulinum toxin and international markets.
And we got pretty specific timelines from them on indoor. EBITDA break even in FY26, but likely PAT losses that year because of financing costs.
Yep.
PAT break even targeted for FY27 and peak revenue potential maybe FY28, FY29, depending heavily on those global approvals.
And just to hammer it home one last time, any discussion around potential market reactions or trade ideas was purely illustrative, based only on interpreting the information management provided in the earnings call transcript. This is not financial advice. Please consult professionals.
Absolutely. So here's a final thought to leave you with based on everything we heard. Given management's own explicit guidance about ongoing near-term margin pressure for the next few quarters and the multi-year journey for the new facility to really boost the bottom line, how do you think the market might value QIT Biosciences over, say, the next 12 to 18 months as it navigates this deliberate but financially taxing transition phase? Something to think about.